Okay, everybody, Principles of Banking, Chapter 13. This is the last one, the last chapter for the semester. So let's jump right in with managing risk. Now, this chapter in the book talks about safeguarding the bank, the economy, and the nation. They're a little bit grandiose, I must admit, in their feelings about bankers safeguarding the nation, but I think we'll come to think that there's a little bit of a role to that. But let's first talk about the CAMELS ratings. And the uniform rating system of banks uses something they call CAMELS, which is an acronym for these classes here, these 6 areas. Capital adequacy, which is that the bank has sufficient capital to absorb losses, promote customer confidence, and help to restrict excessive growth. Part of this in the capital adequacy is that they have to have their 10% on reserve, and they have to have the FDIC insurance on the depositors' deposits. The next one is asset quality. This usually refers to the quality of the assets in a bank's portfolio, and most typically this is about the loans. So are the loans of good quality? Or is the bank lending to good borrowers, and that sort of thing. In some businesses, you might think of asset quality as like, are they have nice buildings or good products? But in a bank, it's really about who are they lending money to, and are they quality borrowers? The next is management. This is the M in CAMELS. This is about, is the management of the bank competent? Are they proficient? Or do they do the things they need to do to protect risks? And are they competent enough to see them coming? Typically, the book at least says that management negligence or failure is the single biggest risk the bank has. Okay, next is earnings. Is the bank earning enough money to keep its operations going, to keep the annual events going on, and the employees are all getting paid, and everything's happening, the bills are getting paid, and so on. Next is liquidity. Liquidity speaks to the ability of a bank, or any business for that matter, to fund its assets and meet financial obligations as they come about. And typically this is, do you have cash to pay the bills on a monthly basis, or even more often? If you saw the movie Too Big to Fail on HBO, which was about the financial crisis of 2008, AIG's big problem in that film and in real life was liquidity. They did not have the cash to pay out their claims, and it was a major issue. And then sensitivity to market risk, and this refers to the degree with which changes in prices, interest rates, and so on can affect the bank's earnings or capital. Biggest of that is probably interest rates, since that's what banks deal with most, but all those market risks could be a factor. Next is the task of safeguarding the bank's assets. And one of these things that's needed to be done is corporate governance and the ethical behavior. So the regulators expect that the bank's board of directors are going to manage senior managers, manage the team here, and sort of overlook the honesty and the forthrightness with the bank's management operates. So the book here outlines several responsibilities to say who's responsible for what. Now, the board of directors typically set the bank's policies and directives and then ensures that management carries those things out. Now, they're primarily responsible for sort of setting up the overall framework through which the rest of the bank's team operates. Now, the audit committee, these are internal auditors who monitor what the management and staff does. Do they follow the policies and procedures set about by the board of directors? Now, there's other board committees. There's a loan committee that approves big loans, reviews problem loans. There's sometimes trust committees, and then there's compensation committees. Compensation committees, typically what they will do is manage the bank's compensation for staff and management, and ensure that people are being compensated equitably and attractively sometimes, but also that the compensation programs do not lead to unethical behavior or lend themselves easily to that sort of thing. Senior management oversees the staff of the bank, and then the auditors, again, these are the people who are evaluating the bank's internal controls and whether or not the employees are following the rules. Employees are also responsible for following the rules, doing ethical things, and blowing the whistle when they see unethical behavior. That's not an easy thing to do, but it is considered a responsibility. Now, when it comes to employee hiring and vendor management, these days banks are being encouraged to take more time and focus more energy on making sure that we pick the right people to both work at the bank and to service the bank's needs through their vendors. And these might be as simple as the company that comes in to clean at night, and it may be those that supply information security and data protection and the like. So a lot to think about in regards to who we hire and who we work with. Okay, so of course this all leads to crimes, or it doesn't lead to it, but it has to do with crimes against banks. And what are the most typical crimes that banks have to do? And first among these is insider fraud. Now, unfortunately, employee theft, embezzlement, and other types of insider fraud are the lion's share of crimes that banks see. And this is, this is a lot more losses than robberies, I'll tell you that much. The book highlights one that's interesting, is that asset misappropriation, such as embezzling money or stealing cashier's checks, blank cashier's checks, and filling them out later. That's a pretty tricky maneuver. I'll tell you a quick story. There was a vault manager for Key Bank, I think it was Key Bank, in Anchorage a few years back here, that managed a vault for the bank's biggest vault that serviced the entire state of Alaska. And this person, at one day on a Friday afternoon, on a holiday weekend, took about $4 million out of the vault and hit the road for Mexico and South America. And I believe that she was caught a couple of weeks later trying to cross a border, and it was either between Nicaragua and Panama or something to that effect. But insider problems, these are where most of the problems come. Bank robbery is a problem, and there's bank robbery is a problem not so much because of the money, because very few bank robberies actually get away with anything, but the potential for injury or death and trauma to employees and customers is very, 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 very troubling. In about half of bank robberies in the country, tellers or other bank employees are physically threatened or attacked. Now, a lot of banks don't encourage their employees to do anything rash. They encourage them to just cooperate and get the customer out of there. And a lot of the times, the person that's robbing the bank doesn't even use a weapon. They just threaten and leave. But it's a big problem because of the physical harm possible. Currency counterfeiting. This is a tough one because it's hard to catch, but people will try to pass off bills that are counterfeit and or altered, and in the attempt to get some money over on the bank. And then there's cashier's check scams. And so cashier's checks are tough because they are the bank has a lot to lose by bouncing a cashier's check, because the bank's reputation goes into the cashier's check, because other banks take it as gospel that they're good. And if a local bank like mine were to suddenly start bouncing cashier's checks because a whole rash of them were stolen, that would mean that now every cashier's check from our bank would be suspect, and a lot of risk involved in something like that. So there's a lot of scams out there. Now let's talk about safeguarding the economy and the nation. You know, I never knew that what I did was so noble until I read this book, but now I feel pretty good about it. But let's talk about banks' roles in some of this stuff. Now, most terrorism is funded by illegal activity that has to have money laundering take place and filter the funds back to terrorist networks. And banks can circumvent that a little bit by catching the schemes before they get too far. So there you go. Bank security systems also provide data and other ways to discourage criminal activities. Banks have programs to combat money laundering, as we've talked about. The Bank Secrecy Act enforces the banks to report certain information to the IRS, to other financial crimes enforcement network like FinCEN. So these help to generate data and information for government agencies. The USA Patriot Act, we talked a little bit about that with the identification program that allows government to try to prevent nefarious people from doing things that are screwy. Blocking accounts and freezing assets is sort of a last resort when we catch on to bad activities and bad actors in our accounts. And then emergency preparedness we talked a little bit about too, where banks have to prepare for potential problems and safeguard their systems against those problems. So that really wraps up chapter 13, or at least it's going to wrap up what I've got to say about it. I tried to stick to the more interesting parts of it and not get bogged down in the minutia. The book is always there to read about the minutia. But good semester, everybody. It's been a pleasure teaching and participating in this course. My word of advice for anyone that's having any trouble is to finish the assignments. We definitely try to be very flexible at CTC, so if you're late on anything and you need help, let me know as soon as possible and we can work something out to make sure that you get the best grade you can. And finish the exams. Now remember, quizzes and homeworks, you get to drop one. The other items, though, you don't get to drop any, so make sure you finish those up as soon as you can. And again, it was a pleasure getting to know you all through the online discussions and the like. Good luck in your future endeavors, and I hope you enjoyed the course. And that'll do it. No more of our fun YouTube videos, but have a great summer and a good career going down the road. Thanks again.